Hello friends, welcome to Silver Rewind. Something crazy just happened in silver markets. Prices spiked, traders panicked, and then just like that, silver flipped direction violently. Many didn't see it coming. In the next 21 days, history suggests we might be in for a major surprise. And one hidden detail, ignored by most news outlets, could completely shift how the market reacts. Stick with me, we're breaking it all down step by step. Unlike stocks or bonds, silver reacts quickly to both fear and opportunity. It is widely regarded as a canary in the coal mine for economic turbulence. Traders and institutional investors track its swings for clues about liquidity, inflation, and recession risks. When silver spikes aggressively and then reverses, it reflects uncertainty in global markets and potential panic among big players. This makes today's reversal particularly concerning, as it could be an early alert to systemic stress that will unfold in the coming weeks. The timing of this movement is also notable. The last few decades show that violent shifts in silver often occur just before market corrections or recessions. In a world of high inflation, global debt, and tight monetary policy, these signals gain even more weight. The unusual volatility is a reflection not only of speculative trading, but also of underlying economic fragility. Observers note that ignoring these warning signs can leave investors exposed when broader markets finally react. For viewers tracking precious metals or seeking to anticipate economic cycles, silver's latest reversal is a must-watch event. The patterns it exhibits now mirror the early days of past recessions, making it both a financial and strategic signal. In short, silver is speaking to us through its price swings, offering insight that traditional financial news often misses. Understanding this movement now can help investors prepare for the shifts that could unfold in just 21 days. Silver is more than a shiny metal or a commodity for investors. It has historically served as money, an industrial asset, and a safe haven during economic uncertainty. Its dual role as both a financial asset and an industrial necessity gives it a unique sensitivity to market conditions. Unlike gold, which is often a purely safe haven play, silver reacts strongly to both demand spikes and economic slowdown. Investors, central banks, and even corporations monitor its price movements to gauge liquidity, inflation expectations, and global risk appetite. Industrial demand amplifies silver's market sensitivity. Electronics, solar panels, and medical equipment rely heavily on silver, making it reactive to shifts in production and supply chains. During periods of economic expansion, silver's price typically rises steadily, but during stress, it can fluctuate violently, reflecting both speculative trading and real-world supply-demand imbalances. This dual nature makes silver an early indicator for broader market turbulence, often signaling risks before they appear in other assets like stocks or bonds. Additionally, silver's historical performance during economic crises reinforces its importance. During past recessions, silver often peaks early and then collapses before the broader market reacts. Traders and analysts closely examine these patterns because silver reacts faster than most other markets. A violent reversal in silver can therefore serve as a bellwether for inflation spikes, credit tightening, or a slowdown in industrial production. Ignoring silver's signals can result in delayed responses to financial and economic stress. Finally, global investor sentiment around silver adds to its predictive power. When fear rises, traders often move from equities to precious metals, with silver frequently acting as the first escape valve. This rapid response makes its price action more volatile and more informative than traditional economic indicators, which are often reported with delays. For anyone trying to anticipate market trends or potential recessions, tracking silver provides a real-time window into economic stress, making today's violent reversal a critical signal. The term market whiplash refers to sharp, unexpected price swings within a short time frame, where markets surge in one direction and then reverse abruptly. In silver, this occurs when buyers push the price higher, only for sellers to dominate moments later, erasing gains. Such moves are not random. They often reflect deeper market confusion, uncertainty, or stress. Traders interpret these events as signals that sentiment has shifted dramatically and that the market may be preparing for larger corrections. Understanding market whiplash is key to reading early warnings from commodities like silver. In practical terms, market whiplash creates extreme volatility. Investors can see gains evaporate in hours or even minutes. These movements tend to happen in assets that are highly sensitive to sentiment and liquidity, such as silver, oil, or certain tech stocks. A violent reversal indicates that confidence is fragile and that risk is concentrated among leveraged participants. In other words, when silver swings sharply and then collapses, it is a reflection of stress in both the physical and financial markets. Market whiplash also provides insights into investor psychology. Sudden reversals show that many traders are unsure about future trends. Buyers overextend, sellers react, and the resulting tug-of-war creates extreme swings. In silver, these movements are magnified by thin trading periods or global events that impact demand and supply simultaneously. Analysts study these reversals carefully because repeated patterns often precede market corrections or broader economic slowdowns, giving a predictive edge. Finally, market whiplash can act as a warning light for upcoming recessions. Historically, violent swings in silver have preceded economic contractions by weeks or even months. These signals are especially valuable because they are real-time, unlike lagging indicators such as GDP or unemployment data. For investors, recognizing and interpreting market whiplash in silver can be the difference between staying ahead of a downturn or being caught off guard. Today's violent reversal is exactly the kind of movement that warrants close attention. Silver recently broke a critical support level, catching many traders by surprise. Buyers rushed in, expecting a continued upward trend, only to see the price reverse violently. This kind of aggressive swing signals stress in the market. Analysts note that these sudden moves often happen when liquidity is low and speculative trading dominates. The speed and magnitude of the reversal made it clear that confidence among market participants is fragile and that large investors may be repositioning their holdings. The reaction was immediate. In minutes, silver moved from gains to losses, creating extreme volatility. This is significant because violent swings like this often precede broader market reactions. It shows that even heavily traded metals can experience panic or overreaction, giving early insight into sentiment shifts in other asset classes. Traders who missed the signal could face losses if similar patterns spread to other markets. Experts point out that this move also aligns with historical patterns, where silver peaks sharply before broader declines. In past cycles, the metal's price often foreshadows stress in equity markets, bond markets, and even industrial sectors. Observing these reversals in real time can provide a strategic advantage for investors who want to prepare for potential downturns before traditional indicators, like economic reports, catch up. Finally, the shock comes from both speed and magnitude. A reversal of this intensity rarely occurs without a triggering factor, such as rising interest rates, tightening credit, or shifts in global demand. The combination of panic selling and institutional repositioning creates a perfect storm. For viewers and investors, this specific move in silver serves as a high-probability warning that the next few weeks could bring heightened economic risk. Violent reversals in silver are more than just trading noise. They signal uncertainty and panic among market participants. Unlike gradual corrections, these reversals show sudden shifts in sentiment. Analysts emphasize that when a market moves violently in a short period, underlying economic stress is often present. Historically, such patterns have preceded recessions, credit tightening, or sharp equity market corrections. For investors, ignoring these reversals can be costly. Markets generally react slowly to real economic data. However, silver and other commodities respond instantly to fear. A violent reversal is a form of market communication, showing where money is flowing and where it's retreating. Traders, hedge funds, and institutional investors interpret these swings as signals to adjust portfolios, protect assets, or hedge risk. These movements often foreshadow broader disruptions before traditional indicators like unemployment or GDP reports reflect the change. Additionally, violent reversals highlight liquidity stress. When liquidity is abundant, markets adjust smoothly. When liquidity tightens, any imbalance between buyers and sellers can trigger dramatic swings. Silver's recent behavior reflects such stress, indicating that large investors may be pulling back from risky positions. This aligns with broader economic concerns, such as rising interest rates or slowing industrial demand. Finally, investors should recognize that these reversals carry predictive value. While no signal is guaranteed, data shows that sharp swings in silver frequently precede market contractions. Ignoring this red flag risks exposure to sudden downturns in stocks, bonds, and commodities. Today's violent reversal is a warning. Market participants must pay attention, as it may be the early stages of a larger economic correction. Silver has a long history of predicting economic stress before other markets react. Traders call it a leading indicator because it moves quickly when conditions change. Unlike stocks or bonds, which may lag economic developments, silver reacts to fear, inflation, and liquidity. Its dual role as both a financial asset and industrial metal makes it sensitive to shifts in both market sentiment and real-world demand. Investors track these movements closely to anticipate risk. Historically, sharp movements in silver often appear weeks before recessions. During the 2008 financial crisis, silver spiked and then reversed before equities fell. The same pattern occurred in the early 2020 recession. These movements allow traders to position themselves ahead of broader market declines. Watching silver closely provides a strategic edge, particularly when other indicators remain calm. Silver's sensitivity comes from its unique market structure. It is highly liquid but also influenced by speculative trading. When fear spreads, investors flock to or flee from silver, creating quick swings. These rapid changes act as a real-time barometer of economic confidence. In essence, silver reacts before headlines, offering a first look at emerging financial stress. Finally, silver's predictive power extends beyond metals markets. Sharp reversals can signal upcoming equity market corrections, credit tightening, or industrial slowdown. While no single indicator is perfect, silver's behavior consistently aligns with broader economic shifts. Investors and analysts who monitor these swings are better prepared for sudden changes, making today's violent reversal especially important. Silver has repeatedly shown patterns that precede recessions. In multiple historical cycles, its price peaks before the broader economy slows. Analysts track these peaks to gauge when markets might enter stress periods. By observing silver, investors can gain a window into potential downturns before traditional indicators, like GDP or unemployment data, reflect the change. The pattern is consistent enough to warrant attention. During the 2008 crisis, silver rallied early, reflecting fear and uncertainty, then fell sharply weeks before equities dropped. Similarly, in 2020, silver surged due to market panic, then reversed violently just before the global slowdown. These historical precedents highlight silver's role as a sensitive barometer. Investors who track its swings are better positioned to respond proactively rather than reactively. Patterns show that violent reversals are particularly significant. Sharp peaks followed by sudden drops often coincide with liquidity stress, rising interest rates, or industrial demand changes. Each reversal provides a signal that markets are uncertain and that economic contractions may follow. Ignoring these historical lessons risks being unprepared for a broader slowdown. Finally, historical data supports the 21-day concept. Many of silver's reversals precede economic turbulence by 2-4 weeks. This timing suggests that short-term traders and long-term investors alike should pay attention. Silver acts as a fast-moving, real-time indicator that can help anticipate risk before traditional metrics catch up. Analysts often point to silver's patterns to anticipate short-term economic stress. The 21-day window refers to the period after a violent reversal in silver during which recession signals often materialize. Historical data shows that silver reacts quickly to market fear, often before equities or bonds reflect stress. By observing its swings, investors can get a predictive edge, understanding that economic contractions frequently follow in a matter of weeks. This window is derived from patterns in multiple market cycles. For instance, in 2008, sharp reversals in silver preceded market slowdowns by roughly 3 weeks. Similarly, during the early 2020 recession, silver peaked and then fell violently before global economic contractions became obvious. This consistency makes the 21-day framework a practical tool for traders and investors seeking to anticipate market risk. The 21-day period is significant because markets react in cycles. Short-term liquidity stress, shifts in investor sentiment, and changes in industrial demand often manifest in these weeks. Silver's unique dual nature, as both a financial asset and an industrial metal, makes its reactions faster than typical market indicators. Its behavior during this window offers a real-time glimpse into the health of the economy. Investors who understand this timing can make more informed decisions. By watching silver's volatility over the next 21 days, they can adjust positions in equities, bonds, and commodities to reduce risk. Ignoring this short-term predictive period may leave portfolios exposed. Essentially, the 21-day window provides a strategic advantage for navigating market turbulence. During the 2008 financial crisis, silver's price surged and then reversed violently. Traders and analysts saw this as an early warning of systemic stress in the global economy. The violent reversal foreshadowed the collapse of credit markets, major bank failures, and a sharp decline in consumer confidence. Those who interpreted silver's movements had critical insight into risk before broader markets reacted. Silver's behavior reflected liquidity constraints in financial markets. Large investors began to sell aggressively after an initial surge, leading to extreme price swings. This mirrored the panic unfolding in credit markets. Observers note that silver often reacts faster than other financial instruments because it responds directly to sentiment, supply-demand imbalances, and economic stress simultaneously. The 2008 signal also highlighted the predictive power of metals. While equities and bonds remained relatively stable initially, silver's reversal signaled that underlying economic foundations were weakening. Investors who monitored the metal could anticipate that major sectors, including banking, housing, and industrial production, would face sharp declines. The metal effectively gave a first warning before economic pain was evident in mainstream data. Finally, the lesson from 2008 is clear. Violent reversals in silver are high-probability indicators of market stress. They signal not only potential equity losses but also broader systemic risks. By understanding these patterns, investors can prepare for economic downturns rather than react too late, giving them a strategic advantage in turbulent markets. In 2020, silver again demonstrated its predictive power. At the onset of the COVID-19 pandemic, silver spiked due to uncertainty in financial markets. Investors flocked to precious metals as safe havens, but this surge quickly reversed violently. The reversal signaled deep systemic stress that preceded widespread economic shutdowns, lockdowns, and supply chain disruptions across industries. Silver's reaction was a reflection of both investor psychology and real-world risk. As markets panicked, liquidity constraints forced rapid selling, creating sharp swings. These movements preceded equity market declines, job losses, and manufacturing slowdowns. Analysts observing silver's patterns were able to anticipate the cascading economic effects weeks before official economic reports were released. The 2020 pattern reinforced silver's status as an early warning signal. Its price movement provided a short-term forecast of the recessionary impact of the pandemic. Investors and institutions who monitored these reversals had valuable insight into market positioning, enabling protective measures in portfolios and risk management strategies. Finally, the violent reversal in silver in 2020 illustrates the metal's unique dual nature. Its price responds to both speculative sentiment and industrial demand simultaneously. This combination allows silver to react faster than traditional economic indicators, providing a predictive lens for short-term financial turbulence. The 21-day window after such reversals becomes a critical period for monitoring potential economic stress. Today's silver reversal echoes past patterns, creating a sense of déjà vu among analysts. Rising debt levels, sticky inflation, and tightening monetary conditions mirror factors seen in previous pre-recession periods. These similarities increase the probability that the current violent reversal is a genuine early warning of economic stress, rather than a short-lived anomaly. The global economy is showing signs of fragility. Consumer spending growth is slowing, industrial demand is uneven, and corporate debt levels remain elevated. These underlying pressures amplify the significance of silver's movements. When combined with violent reversals, these conditions suggest that systemic stress could unfold quickly, just as it did in 2008 and 2020. Market participants are also recognizing that traditional signals are lagging. Employment numbers, GDP data, and other economic indicators are reported with delays. Silver, by contrast, reacts in real time to liquidity, sentiment, and industrial demand. Today's pattern feels familiar because it closely resembles the precursors of past economic downturns, providing an immediate observable warning. Finally, the familiarity of these signals underscores the need for vigilance. Investors cannot afford to ignore silver's price behavior. By studying this pattern and comparing it with historical cycles, analysts can better anticipate market shifts, hedge risk, and navigate potential volatility. The current reversal may serve as a high-probability signal of economic turbulence in the coming weeks. Silver's price is highly sensitive to global liquidity. When money is plentiful, silver tends to rise steadily as investors buy for speculation and industrial demand. However, when liquidity tightens, large positions are sold quickly, causing violent reversals. This is why recent movements in silver are particularly significant. They suggest that liquidity in financial markets may be drying up, which is often a precursor to economic stress. Liquidity affects silver in multiple ways. Central bank policies, interest rate adjustments, and credit conditions influence investor behavior. When borrowing costs rise, traders reduce leveraged positions, which can trigger sharp selling in silver. The recent reversal shows that financial participants are repositioning rapidly, signaling caution and uncertainty in markets. Historical data confirms that silver reacts faster than many other assets to liquidity changes. During the 2008 financial crisis, sudden drops in liquidity caused silver to reverse violently weeks before equities fell. Similarly, in 2020, liquidity constraints during the pandemic triggered rapid swings in metals. These patterns reinforce the idea that silver is a real-time indicator of market health and financial system stress. Investors should view silver as both a metal and a barometer of liquidity conditions. By monitoring its price behavior, one can anticipate tightening credit, rising interest rates, and broader market stress. Today's reversal, in the context of liquidity contraction, is a clear signal that caution is warranted, making silver an essential asset for understanding market dynamics. Bond markets often tell a story that equities do not. Rising bond yields, inverted yield curves, and volatility in debt markets can indicate looming recessions. Silver's violent reversal aligns with subtle signals in bond markets, suggesting that the global economy may be under more stress than stock indices. Reflect. Investors paying attention to both metals and bonds gain an early warning of potential downturns. When bonds react quietly but significantly, it often reflects investor concerns about inflation, credit risk, or economic slowdown. Silver, being highly sensitive to liquidity and sentiment, reacts faster than bonds in real time. The recent movements in silver mirror subtle changes in bond yields, highlighting that institutional investors are already preparing for economic uncertainty. Historical patterns show that bond market stress often coincides with early signals in silver. In both 2008 and 2020, bond yields and curves shifted weeks before recessions, while silver reacted aggressively at the same time. The parallel movement suggests that combined analysis of bonds and silver can provide a more accurate picture of economic risk than either alone. Investors should treat these signals as early alerts. The quiet turbulence in bonds, reflected in silver's violent reversal, implies that liquidity is tightening and risk is increasing. Understanding these correlations allows investors to hedge effectively, manage exposure, and position themselves for potential market volatility. Stock markets can appear calm, even when underlying risks are rising. During periods of economic stress, equities often lag real-world conditions because investors focus on short-term optimism or central bank support. Silver's violent reversal exposes a gap between stock market performance and actual economic health, signaling that risks may be underestimated by many retail investors. This gap occurs because stock prices reflect expectations and sentiment, not immediate real-world conditions. Metals like silver, by contrast, respond instantly to liquidity shifts, inflation concerns, and industrial demand. The recent movements in silver suggest that underlying economic stress exists even if stocks appear stable, warning investors to reconsider their exposure to equities. Historical precedents reinforce this reality gap. Before the 2008 recession and the 2020 pandemic slowdown, equities remained relatively calm for weeks, while silver and other leading indicators showed early warning signs. Ignoring this divergence can leave investors exposed to sudden corrections when markets eventually catch up with reality. The lesson is clear. Silver's behavior often highlights risks hidden from stock market performance. By monitoring this gap between silver and equities, investors can anticipate potential corrections, adjust positions, and avoid being caught off guard. Today's violent reversal in silver serves as a real-time alert that the calm in stocks may be misleading. Most retail investors focus primarily on stocks and ignore precious metals. This limited perspective can create blind spots, leaving them vulnerable to sudden market corrections. Silver's violent reversal highlights risks that mainstream reporting often misses, giving institutional investors an advantage while retail traders remain unprepared. Retail investors are also slower to react because they rely on lagging indicators like economic reports or news headlines. By the time traditional media reports on stress signals, silver has already moved sharply, and markets may have adjusted. This delayed reaction makes violent reversals in silver a particularly valuable early warning signal for those paying attention. Education and awareness are key. Understanding the predictive power of metals like silver allows retail investors to prepare and hedge risk before broader markets react. Ignoring these signals often results in missed opportunities and preventable losses. Silver provides actionable insight into liquidity stress, economic slowdown, and potential market corrections that can benefit any investor. Finally, today's violent reversal is a wake-up call. It shows that even if stock markets appear stable, underlying stress exists. Retail investors who monitor silver and other leading indicators gain a strategic advantage, positioning themselves to act proactively rather than reactively. Paying attention to these early warning signals can protect portfolios and preserve capital during turbulent times.